this question asked me to hit a podcast on some good strategies for bonds, investing in a rising interest rate environment. So she was asking about short-term bonds and money market funds and inflation-adjusted bonds and stable value funds. And I think she's kind of making a classic mistake about extrapolating the past into the future, right? For example, this whole phrase, a rising interest rate environment, assumes you know what's going to happen in the future. It's saying that you know interest rates are going up. And I would propose that you don't know that, at least not any further than the next few months, if the Fed maybe has telegraphed what they're going to do at their next meeting. But for the most part, those prices have already been incorporated, or those interest rate changes have already been incorporated into the prices of bonds. And so I think assuming that you know which way bonds are going to go is a big mistake. Interest rates may go up, they may go down, they may stay flat. I remember after interest rates dropped dramatically after the 2008 crisis, for 6 or 8 years, people talked about, oh, interest rates have nowhere to go but up. They're going to go up. Guess what? They kept going down. They went down, 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 even when everyone was saying they got to go up. Interest rates don't have to go up. They could stay right where they are today for years, for decades. I mean, take a look at Japan. Interest rates have been low for decades in Japan. They could also go back down to where they were a couple of years ago. Interest rates have come up over the last couple of years, and they could easily go back to right where they were. So I think making that assumption that rates are going up and you know they're going up is probably a mistake. I think you need a plan that will allow you to be successful no matter what interest rates do in the future. I mean, seriously, if your plan requires you to have a working crystal ball that tells you what interest rates are going to be in 2 years, that's going to be a pretty tough plan to come up with. I mean, if you had a working crystal ball, what you would do is you would stay in cash until rates are done going up, and then you would switch to long-term bonds until rates are done going down, and then you'd switch again. But none of us have a working crystal ball. Now, you can hedge your bets by keeping your term risk low, by keeping the term of your bonds short. That lowers your interest rate risk. But the problem is there's a very real cost to doing that. And you can see what that cost is by looking at the current yields on various types of bonds. If you just go to the Vanguard page where they list all their mutual funds, I look at it all the time. I just Google Vanguard mutual funds by asset class. You can look at the yields on the various types of fixed income funds there. Right now, as I'm recording this podcast, that says that cash via the Prime Money Market Fund is paying 2.25% per year. Their short-term bond index fund is paying 3.1%. Their intermediate term bond index fund is paying 3.61%. And the long-term bond index fund is paying 4.19%. So that's the price you pay. If you want to stay short in cash at 2.25% instead of long-term bonds at 4.19%, you're giving up 2% a year. That is not insignificant, especially if rates go down from here or even if they just stay where they're at. You basically made a guess, you made a bet on where interest rates are going when you decide to stay short. And I think that can be a dangerous thing to do. In reality, anyway, when you are a long-term investor, when you're a long-term investor in bonds, you want rates to go up. As long as inflation stays stable, as long as inflation isn't going up with them, you want interest rates to be higher. Because once you've invested in those higher interest rate bonds for at least the duration of the bonds you own, then you're coming out ahead. For example, if you have a bunch of bonds at 4% and interest rates go up 1%, so now you can buy bonds at 5%, and the duration of your bonds was 5 years, well, starting at 5 years, you're coming out ahead with that interest rate being higher at 5% instead of 4%. You got to realize that that is a good thing for bond investors. Now, it's not a good thing if inflation goes to 15%, because inflation is particularly bad for bond investors. But as long as inflation is stable, that's good. I mean, even TIPS owners, people who own Treasury inflation protected securities to protect them from unexpected inflation, even they don't want unexpected inflation. And the reason why is because they own other assets most of the time. It's not going to help your job and your buying power and, your other investments, particularly your bonds. And so you don't necessarily want, unexpected inflation at any time. Ideally, that stays low and it stays very stable. Speaking of stable, let's talk about stable value funds. Now, stable value funds are sometimes offered through an insurance company. Probably the most famous one is in the thrift savings plan. that VA workers and military docs have access to. The G fund there is essentially a stable value fund. It offers you bond-like yields with money market fund risk, which is a pretty attractive combination. And so if you have one of those available in your 401k, that's not a bad choice, especially if the yield is pretty high on it. I think that's a good choice if you're really worried that rates are going to go up. Obviously, when rates go down, that's not going to help you much. You normally get a little kicker on your bond returns when rates drop. At least in the short term, you get that kicker. You don't get that in the G fund. Ask me how I know, because I've held the G fund for the last 15 years, most of which interest rates have gone down. And that decision has actually cost me money over the long run. But that's okay. That was my plan, and I stuck with it, and I certainly made up for it in other parts of the plan. But bear in mind that is the risk. In general, with bonds, I prefer a fixed asset allocation strategy. I've just decided I'm going to put 12.5% of my actually it's 10% now of my portfolio into TIPS, and I put 10% into the G fund or similar bond funds for nominal bonds. And I literally just rebalance. I rebalance. I don't change the plan based on what I think interest rates are going to do. And I recommend you adopt a similar approach. Otherwise, you're stuck trying to decide, well, when do I change the duration of my bonds and when do I change them back? And you have to be right not once, but twice when you're trying to time the market like that. And I think that's pretty difficult to do and will cause you a lot of stress trying to do it.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.